You've probably heard the saying, the stock market is a roller coaster. And if you've been following the market in recent years, you know how true that is. One day it's up, the next it's down. It's enough to make anyone nervous about investing. But here's the thing. The most successful investors aren't the ones who try to predict every twist and turn. They're the ones who invest consistently, even in volatile markets. In today's video, I'm going to show you exactly how you can do that, stay calm and build real wealth, no matter what the market is doing. Let's talk about why consistent investing is so important, especially when the market feels like a roller coaster. Think about it. In 2025, we're facing a lot of uncertainty, right? Global events, economic shifts, technology changing faster than ever. It can make the market feel unpredictable. Trying to time the market perfectly is like trying to catch a falling knife. Most people get burned, even the experts. So, what's the solution? It's not about being a market wizard, it's about being a disciplined investor. That's where dollar cost averaging comes in. Imagine this. Instead of stressing about when to buy low and sell high, you invest a fixed amount of money at regular intervals. Let's say it's $500 every month, no matter what the market is doing. Now, when the market takes a dip and prices are down, your $500 buys you more shares. And when the market is soaring high, your $500 buys you fewer shares. This might seem counterintuitive, but over time, this strategy evens out the average price you pay for those shares. It's like buying on sale when the market dips and buying a little less when things are expensive. The beauty of dollar cost averaging is that you take the emotion out of investing. You don't need to panic when the market crashes because you're buying consistently, taking advantage of those dips. And guess what? This consistent, unemotional approach sets the stage for the real magic compound growth. Over time, your consistent investments, combined with the power of compounding, can potentially lead to significant wealth accumulation. Okay, so you're ready to embrace consistent investing. But where do you even begin? Look, just like any journey, you need a roadmap. And in investing, that roadmap is your investment plan. First things first, ask yourself, what are you investing for? Are you dreaming of retiring early on a beach somewhere? Saving for a down payment on your dream home? Maybe securing your children's education? Defining your why is crucial because it's going to be your North Star, keeping you motivated when the market gets bumpy. Next up, let's talk risk tolerance. We're all wired differently, right? Some people are comfortable with high-risk, high-reward investments, while others prefer a more conservative approach. It's crucial to assess your own risk tolerance. How much volatility can you handle without losing sleep? This will guide you in choosing the right mix of investments for your portfolio. Now let's talk about the practical stuff, your budget. How much can you realistically invest each month without stretching your finances too thin? It could be $100, $500, or even more. The key here is consistency, not necessarily the amount. Remember, even small, consistent investments can add up over time. Once you've crafted your investment plan, it's time to put it into action. And here's the most important part. Stick to it. Don't let fear or sensational market headlines derail you from your long-term strategy. Now, let's talk about building your investment portfolio. And trust me, you don't want to put all your eggs in one basket. In the investing world, diversification is your best friend, especially during volatile market conditions. Think of it like this. You wouldn't bet all your money on a single horse race, would you? Diversification is about spreading your investments across different asset classes. Think of it as creating a safety net for your portfolio. So how do you diversify effectively? First, consider investing in a mix of stocks, bonds, and real estate. Stocks offer the potential for high growth, bonds provide stability, and real estate can offer both income and appreciation. It's all about finding the right balance for your risk, tolerance, and goals. Now, if you're just starting out, navigating the world of individual stocks can feel overwhelming. That's where ETFs and index funds come in. ETFs, or exchange-traded funds, and index funds are like pre-built, diversified portfolios. Instead of buying individual stocks, you're buying a basket of stocks, which helps spread risk. And don't limit yourself to your home country. Consider exploring international funds. Why? Because global diversification further spreads risk across different economies. Remember, diversification doesn't eliminate risk entirely, but it's like putting on a seatbelt in a car. It significantly reduces the potential impact of a crash. Chapter 4, Step 3. Automate your investments to stay consistent. All right, let's talk about how to make consistent investing effortless. Because let's face it, life gets busy, and it's easy to forget about our investment goals when we're caught up in the day-to-day grind. That's where automation comes in. Think of automation as your secret weapon for consistent investing. Most brokerage accounts and retirement accounts like your trusty 401k or IRA offer automatic contribution options. You simply set it up once, choose a fixed amount to invest from your bank account each month, and then let the magic of automation do the rest. Now, if you're feeling a little lost in the world of investing and aren't quite ready to pick individual stocks or funds, don't worry. Robo-advisors are here to save the day. Robo-advisors are digital platforms that build and manage a diversified investment portfolio for you based on your financial goals, risk tolerance, and time horizon. They take the guesswork out of investing, and the best part? They handle all the rebalancing for you automatically, making sure your portfolio stays aligned with your plan. But the real beauty of automation goes beyond convenience. It removes the temptation to time the market. Remember, even seasoned investors with years of experience can't predict short-term market movements consistently. By automating your investments, you take emotions out of the equation and stay laser-focused on the long game. You're essentially investing like clockwork, regardless of the market's mood swings. Now, let's address the elephant in the room: market volatility. I know those dramatic headlines about market drops can be nerve-wracking, but here's a little secret: successful investors don't fear volatility, they embrace it. Think about it like this: when the market dips, it's like a massive sale on stocks. Those companies you've been eyeing, their prices just got more attractive. Instead of panicking, see market downturns as opportunities to buy quality investments at a discount. Remember, investing is a long game. Those short-term fluctuations in the market are like ripples on the surface of a vast ocean. The real growth happens beneath the surface over the long term. Now, it's perfectly normal to feel a surge of anxiety when the market takes a tumble. But here's the thing: reacting emotionally, especially by selling your investments when the market is down, is one of the biggest mistakes you can make. Instead of giving in to fear, remind yourself that historically, the market has always trended upwards over the long term. Every market downturn in history has eventually been followed by a recovery. All right, so you've set your investment plan, diversified your portfolio, and automated your contributions. You're well on your way to building wealth. But it doesn't stop there. Just like a car needs regular maintenance to run smoothly, your investment portfolio needs periodic checkups too. Don't worry, I'm not talking about obsessing over your portfolio every single day. But it's a good idea to review your investments at least once a year, maybe even quarterly. During these checkups, ask yourself, are your investments still aligned with your long-term goals? Have your risk tolerance or financial circumstances changed? Has one asset class significantly outperformed others, throwing your portfolio out of balance? This is where rebalancing comes in. Rebalancing is like hitting the reset button on your portfolio. It involves selling some investments that have grown significantly and using those proceeds to buy more of others that haven't performed as well. This ensures that your portfolio stays true to your original asset allocation and risk profile. For example, let's say you started with a portfolio of 60% stocks and 40% bonds. But after a year, the stock market surged, and now your portfolio is 80% stocks and 20% bonds. Rebalancing would involve selling some of those high-flying stocks and buying more bonds to bring your allocation back to the target 60-40 split. We've covered a lot of ground today, from understanding the power of dollar cost averaging to embracing market volatility. Now let's talk about the most important ingredient, your mindset. Investing consistently, especially in a volatile market, requires patience, discipline, and a healthy dose of optimism. It's about trusting the process and keeping your eyes on the prize. Remember, the most successful investors aren't the ones chasing quick profits or timing the market perfectly. They're the ones who stay the course, riding out the inevitable ups and downs of the market with a long-term perspective. So focus on your why. Visualize yourself achieving those financial goals, whether it's retiring on your own terms, buying your dream home, or securing your children's future. Trust in the power of time, consistency, and compound growth. Every dollar you invest, every month you stay the course, is a brick in the foundation of your financial future. As the saying goes, the best time to start investing was yesterday. The second best time is today. Start now, stay consistent, and let the magic of compounding work its wonders. If you found this guide helpful, don't forget to like, share, and subscribe for more tips on mastering the stock market and building your wealth. #consistent investing, #market volatility, #financial success 2025. Remember, with this strategy, you'll be prepared to navigate any market condition and build wealth over the long term. Stay the course, and your future self will thank you.